Welcome to BISP Solution. My name is Anand, and today we are going to learn about the basics of FCCS, means the consolidation process involved under the Oracle tool FCCS. So, welcome to BISP Solution. My name is Anand, and today we are going to learn about the financial consolidation concept. So let's start with an introduction. What is a consolidation? So the dictionary meaning of consolidation is basically the act of combining or joining or adding something, or simply we can say the integrating something. Means we are joining or we are aggregating something. So but from financial consolidation purpose, the process, it means the process of combining financial data of more than one entities which are part of a common organization. From account reference, it means this one. And from we can further say that financial consolidation is a well defined process involving complexity and demands sound knowledge of accounting principles. So yeah, the financial consolidation, uh, it is more than adding the numbers and need to make specific calculation and adjustment to arrive at the final consolidation of an organization. So here we combine the financial results of different entities to to arrive at a result of an group as a single common entity. So the typical steps which are involved in financial consolidation process are means trial balance collection. Trial balance here mean that is assets, liabilities, equity, revenue and expenses details are combined together, or they are collected at a common platform or at a common place of different entities of a group, and they have been mapped to a common chart of account to for their to ensure a single financial results of the different entities. The second step involve a typical steps, which is consolidating the financial data as per defined rules and principles as enumerated in the gap of a specific country and IFRS. That is generally accepted accounting principles of country, which generally governs the accounting rules and principles. The third steps, we can say, reporting these results to internal and external stakeholders. So there are many interested peoples who are keen to know about the financial results of an group or of an entity of a group. Maybe the person who has invested in shares, the banks, the financial institution, government, and other stakeholders. And beside this, there were several internal stakeholders were there: the management, CEO, vice president, and the other board of directors. So in the financial world, the consolidation of financial reports and its accounting were done manually for earlier years. But presently, for this purpose, several types of software and tools are available to take care this manual activity. It helps and support for business and deliver error-free, accurately, real-time basis result. So here we have to say that this process of consolidation is done manually in the previous years or in the earlier years, but for this purpose, to handle with this complex process and a lengthy and a error, and to make it error free, now the several software and tools are available which make it happen. So Oracle FCCS application is one of such tool is one of such tool which facilitates financial consolidation in an easy and smooth manner. It takes into account those specific calculation and consolidation adjustment required to combine the financial results of the parent and its subsidiary. That is, this FCCS application of Oracle, it enables the financial consolidation of different entities. So it helps us to it has eased our work now. So it provides some benefits, or it they made certain adjustment or the calculation which we are supposed to do manually, and which is a very complex and then error prone activity. It and have been handled by the application in a very smooth manner. That is some intercompany transactions and their adjustment, general entries to which are necessary to pass or to adjust, and adjust ledgers, and to take care of the certain transactions and activities. And foreign currency translation, all these activities is done through, we can achieve through Oracle application. Only just we need to input those details for enabling this result. So here we are saying the consolidation of different entities for a group. So here, so what are the different types of consolidation? So in consolidation, we combine the uh, financial results of different entities which are a part of a group into a one single common entity. So the group here means the owner company, the which holds the shares of different entities. So there are the different categories, and there are the different types of consolidation which are required to take place. So under this consolidation, the first consolidation is a consolidation, or consolidation method is a, we can say that a consolidation method or a subsidiary method, in which the parent company holds more than 50% but less than 100% of the shares of other company. So the company which holds the share is known as parent, and the company of which it holds of its purchase the share is known as subsidiary. So a parent can have a one or more than one subsidiary. So the parent company has a significant controlling power over the financial and operating decisions of the subsidiary. That is, if the parent company holds more than 50% and less than 100%, it applies a significant control and power. That is, it can affect, or it can influence the financial and operating decisions of subsidiary. And in this case, the assets and liabilities are combined periodically and reported. That is, the assets and liabilities of all the assets and liabilities of subsidiary are combined along with the parent company to give the final position of a group, or the of the parent company. Similarly, the other method is equity method. The other method is equity method, in which equity or a associate method, we associate method is also we say to this, wherein the parent company holds a minimum of 20% but less than 50% of the shares of an subsidiary, and the parent has significant influence, that is power to participate in the financial and operating decision of the entity and associate. So in consolidation, it has a significant controlling power, while in equity method, it has a significant influence, that is, it can affect the, or change to some extent the financial and operating decision which are taken by the subsidiary or entity or associate. So under this method, the assets and liabilities are not combined, but they are recorded as an investment in the books of owner company. That is, it has a contrary to consolidation method. Equity method is assets and liabilities are not combined, but the investment made, that is the purchase price or the cost of the share, is recorded in the parent company. And the third method is the cost method, under which the company, when a company holds less than 20% shares in an entity, then the cost method is generally applied. So in this case, the investment is recorded at its purchase price, and any changes in investment is take place only when they are sold or new shares are purchased. That is, the investment is being shown in its purchase price. That is historical cost, and no changes it made unless it has been sold or new shares are purchased. Similarly, the assets and liabilities are not combined here, but recorded as an investment in the books of owner company. here, and the dividend which is received and the income or the dividend which we received against this share is shown under as an income under the P&L of the subsidiary company in the parent company, sorry. And the fourth one, we can say the fully owned subsidiary, that is the parent company holds 100% shares, but still it provides a different identity or a different we can say a different status to the sharing company or to the subsidiary company, although it has own 100% share, but it gives an separate identity to the subsidiary, and it works on its own name and activities and framework. The subsidiary works with the parent company's approval. Parent may or may not have direct input into activities and management of the wholly owned subsidiary. That is, the subsidiary company takes the approvals and guidance from the parent, but there may be a case that the parent may have a direct input, or it may leave it up to the subsidiary to work on its own, though it has own 100% share in it. So in this case also, the assets and liabilities are combined together and reported as as a common single entity. So since it is an 100% share, the assets and liabilities are combined periodically. So these are the different consolidation types. So in the next step, we will first from the application perspective, we will see the a typical FCCS life cycle in the of an application. So let me show you the application. So this is in our application EPM Cloud Financial Consolidation and Close. So, and this is the name of the application, that is BISCNSL, through which we can take the through which we can consolidate the activities which I have defined here. That is collection of trial balance, consolidation, reporting results to internal and external stakeholder. Similarly, this adjustment, intercompany adjustment, journal entries, and foreign currency transaction, and this manual work which were done earlier is now been automated through this Oracle application. So what I meant to say, so this all these activities is taken care by application, and the application is here. This is the application. So for this purpose, it has a very typical FCCS life cycle, which I want to explain to you. That is for this application specific life cycle, I have told you in general the total typical steps which are involved, collection of trial balance and other things. But for this from application perspective, the typical steps or the life cycle is here is given in this slide. That is, we first need to create an application. That is, this is the application which we have created and have given the name as VISCN as a vision application, we can say that. And into which we have to load metadata. Metadata here means the account structure, the account expansion, account structure. That is, we have to define the income, revenue, assets, liabilities, heads for the different entities. That is, we have to prepare a common chart of account for combining the results of all the financial result of all these subsidiaries. So here we need to define the metadata. So that is known as metadata. And the next step, the typical step, is load actual data and the historical budget and forecast. After loading the metadata, we load the actual figures. That is, actual figure here means the trial balance figure which we received from the different entities. So we load here the actual as well as the historical data. Here means the last year figures, last year financial results, and also the budgets and forecast of different entities are can be loaded in this application through dimensions. The third step is we can input and direct input as we have loaded through different tools available in the application to the different aspect. And after the load of actual and historical data, if there is some entries which are need to be additionally defined or to be given, so we can do that also through data forms, and we can adjust, and we can always adjust these number through passing general entries. And further, we need to define the ownership structure, that is the ownership percentage, holding, subsidiary status, which company owns, which entity owns the different shareholders, what is the ownership percentage, the which companies are holding, which companies are are proportional or the associate, means that is the companies which we are, that is we define these entities, parent companies, subsidiary companies, which are those equity companies, and cost method, and the cost means for which we are holding less than 20% shares. So we define all these activities in this application. And after defining this, we just run the consolidation process, which is available in this application, and which automatically derive the results, and result which provides a combined figure of an mm, financial result of different entities and subsidiaries. Similarly, after the results are available, we analyze and present those reports for external and internal report, through which we can analyze and present the financial results as a single economic entity for an and foreign parent company or for a group company. So this is the this is our application. And before going to how to create this, how we create this, how we arrived this application, we can first just quickly see a typical financial consolidation manually, that is in an Excel form. How does it work and what this application works, what it calculate. So in this example, we have a figures, financial figures of two companies, that is Micro Limited and Mini Limited. So Micro Limited is an purchaser and Mini Limited is subsidiary. So this is the assets of a purchaser, that is subsidiary. We can parent. We can also say this as a parent, and this is the subsidiary. And the liability and the share capital is given here, and similarly the financial figures of subsidiary, that is Mini Limited, is given here. So these are the assets, and these are the assets and liabilities and equity. So, and the additional information we have given, the 70% shares were purchased by Micro Limited in Mini Limited. So it means the Micro Limited has acquired 70% stake in Mini Limited. That is, it has purchased 70% share, it owns 70% shares of Mini Limited. So here the as we learn, so here we will apply the consolidation method, that is because it owns more than 50% shares. So in this case, what we do in manually, since the share capital of Mini Limited is 1,50,000, while we are paying 2,50,000, so we will first calculate the amount of goodwill. Is there any goodwill arises? So we will calculate here, or we can simply typically say, we will show it you. And so in this consolidation, we simply add the assets and liabilities of parent and subsidiary. So trade receivable, cash and bank balance, equipment. So investment is there. So investment, we do the working. Goodwill, for this goodwill we are doing, we will be working. And for share capital, we will consider only the share capital of purchaser, because we own more than 50% stake in the mini limited. For retain earning, we will be doing the working, and non-controlling interest we will be doing controlling working, and for trade payable, that is the current liabilities, or you can say liabilities, we will just simply add it. So the still the balance sheet is not balanced, so we will do the uh, working here. So investment in subsidiary, this amount is ignored. It's ignored. And for goodwill, we will be doing the goodwill working here. So this is the purchase price that the subsidiary has paid, that is the investment it has made in uh, mini limited, in its subsidiary parent company's investment 2,50,000. So here we will consider the non-controlling interest at the time of acquisition. So the share capital is 1,50,000, out of which 30% belongs to other shareholders. That is the percentage which is not owned by the micro limited, that is purchaser or parent company. So the 30% share belongs to other stakeholder, other shareholders. So we will consider that amount while calculating the goodwill, and we will deduct the share capital, that is the share capital which we have purchased from mini limited, that is the purchase total. Purchase is 1,50,000. The capital as on date was 1,50,000. So the total, so the net figure comes to 1,50,000, 1,45,000. So this will be our goodwill, because we are paying more than what the subsidiary has its value. So it will be 1,45,000. Share capital, we will, since we have acquired the the total share capital, that is the 70%. So we will ignore this 1,50,000, and in consolidation we consider only the share capital of purchaser or the parent. So we will take here as 4 lakh. Retain earning, we will doing the working here. So this is the earning of parent company, and we will take the 70% share from mini limited, that is subsidiary, that is the retain earning, because we we have 70% stake in it. So it comes to 70,000, that is of 1 lakh it comes to 70,000. So the total comes to 1,80,000. This will be our retain earning, or we can say in simple language, in common language, it is an profit for a company. The profit which we own as a parent company and which we acquire from our subsidiary, this comes to 1,85,000. Similarly, for non-controlling interest, we will do the working here. So the non-controlling interest percentage is here 30%. That is 30% of 1,50,000. That is the share capital which is owned by the subsidiary, and the 30% is still belong to other stakeholder, 45,000. So here comes to one third 45,000. And similarly, the the retain earning, the profit which the subsidiary has earned, out of which this 30% belongs to non-controlling interest, that is the other shareholder. So that amount we will consider here. So it comes to 1 lakh 30% of 1 lakh, it comes to 30,000. So the total comes to 75,000, which we will use show it as non-controlling interest. So it comes to 75,000, and it makes our total of liability 8,50,000, and for the asset it comes to 8,50,000. So it makes it tally our balance sheet. So all this process which I have done manually here is being done through our application. Done through application. Only we just need to define, load, or we can say the insert the figure, or load these figures, trial balance of parent and subsidiaries into the application, which we will see in our next session. And the application tools give out the provide us the this figure 8,50,000, 8,50,000. These figures are. So all this process, that is mm, the intercompany adjustment, journal entries, foreign currency, another calculation of goodwill, retain earning. All this calculation is done automatically through this application. So this is the application front page, or you can say the uh, desktop of a front page here. And how this application is created, which we will see. This is the application and the different the features which we are enables, which are available, and which are those makes this application working is given here. This is the a typical application enable feature, that is the consolidation, multi-gap reporting, intercompany consolidation, general adjustment, accounts reporting, ownership management, equity pickup. Those uh, features which we will enable and will be available under this application. So let's see, go through this. So this is the dimension option, from where we can see the different dimension or the, yeah, this is the account where we store the our account structure or the chart of account. Typically we can say the expense code and the numbers. So this is the cash and cash equivalent. So this is the the code 11101, and what is the name of this account is defined in this alias account. Bank checking, so 11200 is our cash account where we will pass the entry. So a typical balance sheet hierarchy is given here under FCCS balance sheet. So balance sheet in traditional approach, total asset and total liabilities and equity. So therefore total asset is always and must be equal to total liabilities and equities. So we just need to provide the figure in this dimensions. Similarly, it works. We have a consolidation dimensions, which helps us to consolidate the activity. Then we have a data source, different data source from where we can load the data into this application. That is loading of trial balance. This process, this loading of trial balance, assets, liability, and this thing. There are the different sources we can input manually through bulk loading, and there are other integration tools are there. Data management, we can pass through general entries. All these activities are we have a data source. Similarly, we have a foreign the currencies defined for different entities, which helps us to calculate the figures. And in case of foreign currency, it it helps us to arrive at a undertake the foreign currency exchange rates. By defining, we can automatically calculate the foreign currency value. Similarly, we have an intercompany transaction. It is naturally that the companies having different entities can have a um, can have a transaction with the entities of a similar group. So that activities have been taken care of by this intercompany. So a typical FCCS application is there. So in our coming session, we will learn how this application is created. So we will make this application loaded into live in our next class. By taking those figures which in features which are required and those which are not required. So we will take this in our next class. and this is for the today's class. I think this an intro this it is an introduction session. So I think it has covered meaningful topics, all the meaningful topics which are required. What is consolidation and how does we do, and uh, with the help of this application, how we can achieve this result, the goal of financial results of a company. And in case of any doubt or question, you can reach us to us on our website bispsolution.com. Reach us to us on our bispsolutions.com. So that's all for today. uh, in our next class, in our next session, we will learn how we can create this application, how this application is created, and how this dimension and other aspect of this application. Thank you.